I am Abhishek Goenka from IFA Global. Lately, I've been hearing a lot of this structures coming in from clients, and lately, few of our clients who are having net worth of more than 500 crores, they have been coming up with structures which I think banks are giving them in terms of selling something, getting a better rate than the forward. What are these structures known as? They are known as TARF. Now, let's understand the structure and let's look at the pros and cons, and then you will be in a better position to decide whether it really makes sense for a company or not. So, TARF is nothing but a simple structure where you are getting something better than the forward rate. Now, as you all are experienced and aware, that there is no free lunch in financial markets, and if you're getting something forward, you're getting something better than forward, you need to sacrifice something in return. So let's look at a simple example of the structure and then look at the three circumstances or three instances that can happen. Now, the structure is very simple. Say uh, you get a chance to sell $1 million every month for the next 12 months. So, say we are sitting in June. So, from July to say next June, you're going to sell $1 million. Uh, and you're going to get something better than the forward rate. So in case the average forward rate, say for example, is 82 half, instead of 82 half, you are going to get 83 half. So that's like a 1 rupee extra carry in an environment where there is an extremely low carry. The premiums are all the way down from 4.5% to say 1.5, 2%. The volatility has crashed completely for dollar rupee, all the way from 6%. It has come to below 4%. So there is a sense of complacency in the market that in the last 7 months, dollar rupee has not gone anywhere. RBI is on both sides. So there is a high probability, that's what the market feels, what the market participant feels, that rupee is going to be somewhere in the range of say 82 to 83 or 81 half 83. Now let's look at three different scenarios. Number one, where suddenly things go extremely interesting in India, we get billions of dollars of flow, oil further crashes, and rupee goes all the way to 80. Now, under that circumstance, this structure may not be very lucrative. Why? Because initially you decided that you are going to send $1 million every month. So that's $12 million notional. But the entire carry that the bank is maximum giving you for a structure is say 12 rupees. That means from the strike rate, that's in this case is 83 half, and the expiry price per month, say expiry is going to be 82, 81 half, 81, 82. Average expiry is say 81. Now 83 half minus 81 is 2.5 rupees. And the bank is going to give you say 12 rupees maximum. So if you get on an average 2.5 rupees difference, then maximum you're going to sustain for less than 6 months. That means initially what you thought that you're going to sell $12 million, you may not sell $12 million, but only less than $6 million because that 12 rupees carry would have been exhausted. So at the back of the mind, if you commit a rate to your buyer that I'm going to price it at 83 half and then give you a dollar price, and at the end of the expiry, you might feel that you sold $12 million worth of product, but ultimately you could only sell or cover 6 million or less at 83 half rate. And the rest of the 6 million you will be selling in the market. And if the rupee doesn't depreciate, it stays at 80 levels, then your average realizations come down. So one thing is for sure, that if the view is that rupee is going to get stronger, then this structure is not for you. The second scenario, which is a scenario that most of the people are banking on, is that rupee is going to be range bound because dollar RBI is on both sides. But you and I both know that in the last 20 years of me tracking the markets, if 6 7 months a currency has been stuck in a range, likely the range is likely to break. Now, where is it going to go? Whether it's going to go to 86 or whether it's going to 80, that's anybody's guess, and that's an event which is random. It will depend on the oil prices, depend on the flows and various other factors, which is difficult to predict. But the point is, only and only case where the rupee is in the range of 81, 83, you stand to gain. And you will be able to realize 10 rupees, 11 rupees, or 12 rupees, something around, but maximum 12 rupees. And the third scenario, if rupee depreciates. Now, if you are running on greed, instead of 1/4 of exposure that you needed to cover, that was your broad hedge ratio, you decided to go for another quarter. Now, if another quarter you cover and you don't have the cost decided, then you are selling at 83 half, and that's the best you can get. So, in the second quarter, if the market goes higher and you have a strip of 12 months for $1 million, the max you are going to get is 83 half. So, in a very depreciating environment or in a very appreciating environment, this structure will not make sense. Only in a case of a range bound environment, you might end up getting enough value for your buck and you can absorb the entire 12 rupees. So I think whenever you look at structures like this, just don't look at the recency thing, what has happened in the last 5, 6 months. Take a holistic view and look at some of the areas, other areas also, like for example, what is the cost of exiting this structure? Now you are selling walls here. So if the walls go up, the cost of exiting this structure will also get expensive. Number two, your notional, what you're thinking about 12 million is not going to be 12 million. It could be 5 million, 6 million, 7 million, depending on the expiry of the rate. And third is you have committed a rate, which later on you realize that the rate is not getting covered and you are on the market. So plus is only and only if the market is range bound. In rest, both the other conditions, you're going to lose money. So I feel even if you have to do this structure, you should only do this structure if number one, your rate is confirmed, and number two, you shouldn't be doing it for a large exposure. You can do it for 5-10% of the positions, so that the impact is not much on the PNL. And if your view is the market is going to be range bound, then you might get some extra carry. But otherwise, if you do it for a larger size, then I think it could be a problem and you end up selling more or you end up exposing yourself for the larger notional. A detailed explanation of this particular structure is on our website, www.ifaglobal.net. I think the link is given below also, you can refer to that. And you can see the entire payoff and then do a probability analysis that how much you need to do, whether you really need to do, and what's the payoff. And in case you want to do something similar, then you can do certain structures where you don't have to do a strip. You can do a month on month basis with uh, with an enhanced forward with knockouts, where even if the knockout happens, your particular 1 month gets spoiled, not the entire 12 months. So you can connect with our team, the smart people who understand derivatives very, very well. They can price these structures for you on important softwares, and then you can play around and then decide how can you use these structures for your benefit, right? Thank you once again. This was Abhishek Goenka. Stay tuned for many such videos and subscribe if you like. Thank you so much. Bye.